Hi, good afternoon and welcome everyone. So today we have with us Mathan, the Senior Research Analyst at Shares and Value. How are you?
I'm good.
Excellent. Well, look, I'm a big fan of yours. I just want to put it out there. I'm very excited to do a bit of a recap with you today. So are you ready?
I'm good to go.
Wonderful. Well, look, I really want to start off. Let's talk about the macro conditions at the moment, the big picture stuff. Like, what are you seeing right now in terms of US growth, the Fed policy, China demand, and how does that all of it feed into the commodity cycle?
Yeah, we're in fascinating times.
Yeah.
I'm a huge fan of cycles because they drive everything. And we are in probably things that haven't happened for 40, 50 years.
Okay.
So most people say, this has happened before. No, it hasn't.
Okay.
There's probably 5% of the finance industry who's actually been around to know how it plays out. So we're in unique times. In the context of the US economy, I think we're in fascinating time as far as where their debt is.
Sure.
It is unprecedented. The growth is unprecedented, right? The political fighting is unprecedented.
Sure.
And there is no real solution to come back from it. Debt is at 38 trillion. The biggest component that's driving the debt is the interest payment on the debt.
Sure.
So even if they don't do anything, the debt literally grows itself.
Self-compounds.
Exactly. The compounding effect the wrong way. So US has literally lost control.
Yeah.
And how do they get it back? Well, last time they ran a surplus was when Clinton was in power. So it doesn't happen often. And there is no political capital to run one. So debt will continue to grow. And the cost of debt is probably going to remain relatively high. Where the first decade, since the 70s, where the cost of borrowing could be higher in the next 10 years than it has been in the last 10.
Sure.
Right? So it is unique times.
And look, there are some members with a lot of respect that have been around long enough to have seen these cycles, but you said it's different, and I always find it fascinating when people say it's different. So what are the hallmarks that makes you tell us and confirm it's different to what happened in the 70s?
Yeah, look, even throughout the last 40, 50 years,
sure,
no one's actually lost control of debt to the level we're doing on a global basis.
Okay.
It is not just one country.
Sure.
We have property bubble around the world. There are countries in Europe that nobody cares about investing in property, but they have a property bubble. There is only one country in the world that doesn't have a property bubble, and that's China.
Okay.
They intentionally, literally destroyed their property bubble over 3-4 years.
Yes.
And at the peak, it was the biggest asset class in the world, right? They took it down. There's a reason why they did that. They knew if everyone is sitting on asset bubbles, the last thing they want to do is sit on one, because when everyone else blows up, they're going to go down with it. So they actively took that out because of the demographic change. They wanted the young people to have more kids. Cost of living was high, predominantly driven by property and
education.
Education, tech, all of them cost too much. They literally pulled all of that cost down.
Okay.
There are more people in China getting married now than they did last year, which hasn't happened for a long time. So things are changing, but what they did is a real catalyst and a wake-up call to everyone. Why are they taking that much pain over the 3-4 years? Because they want a change in the dynamics. So I think there are things that are going to change, and you have to look at the big countries who are actually trying to do something.
Thank you for that extremely eloquent breakdown of that statement. Now, I want to ask you something. So when leadership gets this narrow, capital usually rotates, and where do you see this moving?
Yeah, so if you look at the US market, you've got the top 10 stocks. They're about 40% of the index.
That's correct.
So you can literally control 20% of the global markets by buying a handful of stocks, which is amazing times. Even in the dot-com era, it only got to 20-30%. It never got to 40%. So we've gone to stretch level. In Australia, we have 3 stocks that literally have about 30% of the index.
Okay, and what are they?
Basically CBA,
yes,
BHP, and
yes.
CSL.
Yep.
3 biggest players of 3 different sectors. They almost control the index. So global fund managers can buy and sell CBA because it's a very liquid stock. They literally move the index by doing that. So when they want to defend the market, they buy CBA.
Sure.
And hence why CBA currently is so extremely expensive. It's a yield stock that pays less yield than the bonds.
Okay.
It is probably 40-50% overvalued. But yet, here we are. Interesting times.
It's true. Now, look, let's talk about this. Like right now with record debt, I don't consider AI hype and also rising geopolitical tension. But the truth is, I feel like for the last few years, we've been having the similar tensions. I mean, how is this shaping the investor positioning?
Yeah, it's one word, crazy.
Yep.
You can't justify how things are. Like before, you had one war, everyone will panic. We have numerous wars and
Yes,
no
we
one
do.
cares. We have one asset bubble, everyone worries. We have numerous asset bubbles, no one's worried. There's a lot of things that are being masked. So I think people get confused between what is the market
Yep.
and what's the economy.
Yep.
Right? So we have extremely high asset prices. They come at a cost. The cost of having those asset prices that high is hurting the economy. So the economy is suffering. So if you look at US, 60% of the consumer spending in the US is done by the top 10%.
Okay.
So if you look at the bottom 60% of the population, they only make up 20% of the consumer spending. And that's becoming worse and worse. So these things are all part and parcel of asset bubbles. People don't realize when, say, in Australia, we love property, right?
Yes.
It's the biggest religion, right?
It's a national sport.
Exactly. If you talk badly about property, it's blasphemy, right? But the property bubble hurts the economy.
Sure.
To a certain point, it supports the economy, but after that, it starts to hurt. You don't need to be a genius to work it out. When the average person, you can Google it, earns X amount of money in a family of two, can they afford the average house in Sydney? No. You're in a bubble. That's as simple as that. The governments are keeping it supported because the flow down effect of that bubble is too risky. So we're going to try and keep bubbles as long as we can, and then when we can't, it's all going to unravel.
And when you say unravel, are there going to be hallmarks and signs that our average investor can keep an eye on?
Yeah, it's the standard cyclical problems, right? Retail spending starts to weaken.
Okay.
Unemployment starts to pick up, right? And corporate starts to let go of people. The biggest corporations in Australia are the banks.
Yep.
And the banks have been firing people for the last 2 to 3 years.
Sure.
I mean, think of CommBank. It's the biggest stock in the market, and it continues to let go of people, right? And they're not doing that because things are great. They're doing that because costs are high, and they try to keep cutting costs.
But can I challenge you when some of our investors are now saying, well, with AI, isn't a lot of those repetition, lower level tasks now being replaced by AI? Perhaps it's not so much, making people redundant because of the economic environment, but rather efficiencies.
And we've had automation for decades.
Okay.
We've always had gradual automation. Now, AI is the next level of automation. And I have no doubt AI will deliver economic upswing.
Yep.
There will be cost saving, and it will do quite well, because where it comes in handy is when it can do large scale things very quickly.
Sure.
But the question is going to be are the banks in a situation suddenly they can do these things completely AI? No. They will still need humans to overlook it. It'll take time. These things don't happen overnight. I mean, if you look back at the dot-com bubble, after the bubble, Amazon nearly went bust 3 times. Amazon is a phenomenal business.
Yep.
But it takes time, even then, for the internet to come through and the models to evolve. And it took about 5-6 years. I don't think it's a hugely different now. I think AI will deliver economic upside, but the market is at 20-25-year high multiple.
Yes.
It's pricing in decades of growth. Usually, that never works out. What happens is you go through the reality of things, takes a bit of time, and then it comes through in the economy. And I think that'll happen again.
Sure. So you've identified one of the pillars that we need to look out for. So you look rising unemployment. And what else is another sign of deraveling?
Basically, you'll start to see retail sales struggle despite inflation.
Sure.
The other thing that we in the current cycle, which is quite unique, is what the bond market is saying.
Okay.
So the bond market, we've seen it in the US, we've seen it in Australia. The central banks are cutting rates. but the bond yields haven't really come down yet.
Okay.
Now, bond market is saying you've got too much debt. You're going to issue a lot of bonds. So I'm going to wait because I don't need to buy your bonds because you're going to issue more than what you're saying. Right? As debt rises, you're going to issue more and more bonds. Now, if the bond yields collapse in that environment, then the bond market is worried about the economy. Bond market is the best market to manage risk.
Okay.
Equity is optimistic. Bonds are pessimistic. So bonds manage your risk. So if bond yields are rolling over, that's not a good sign.
Okay. So where are we on these 3 red lines you've just indicated?
Well, you can probably Google unemployment, and everyone's having a bit of a panic attack in Australia that unemployment's going up.
Yes.
It's historically low. So if you look at it pre-pandemic,
Sure.
between GFC and pandemic, about 15 years, we averaged about 5.5%.
Okay.
So at the moment we are 4.5. It's pretty low. With the levels we get to around the 4s, that only happens when we have extreme stimulus. We had that post-pandemic.
Yes.
So we're just trying to normalize. So I think it's a bit of a panic at 4%. I think till you get to 5%, you don't really have to worry.
Sure.
But it is natural to see around the world that unemployment is starting to tick up, which is what happens in this cycle, right? So we're starting to see unemployment go up, and we're starting to see retail sales struggle.
Sure.
And we're starting to see bond yields starting to roll over. And so all of these things are starting to show early signs that asset bubbles are at risk.
Thank you, Mathan. Now, look, not all sectors perform the same in a slowdown. I guess, crystal ball stuff. Which ones look best placed in this environment?
Yeah, so for us, we kind of played out this scenario in our heads.
Yep.
We looked at most of the permutation and combinations. And the most likely scenario was that politicians, on self-interest, will never do the right thing. As Churchill said about the Americans, you're almost certain that they will do the right thing after they've tried everything else. So they're going to do the wrong thing.
Sure.
And, if you look at what's happening, it is literally that's the policy work. They are going to try and keep the asset bubbles and see how far they can go.
Sure.
Till they can't anymore, right? So in that context, we assumed that they will defend the asset bubbles. They will let inflation run. They will do a lot of policies that are distracting, like giving 5% first home buyers plan, which is crazy because you're trying to help affordability by pushing up house prices. That makes sense to me. So we do those kind of policy distractions. And in the US, you've got, we're taking over Greenland, we're taking over Venezuela, we're sending National Guard. All of these things are distractions from the economic problems, right? So those things are playing out, and I don't think the politicians are ever going to suddenly turn around and do the right thing.
Sure.
They're going to literally now, they're kind of stuck in their path. They're just going to keep going till something breaks. So the standard play that people look for is banks getting into trouble, regional banks in the US. We're beginning to start to see a few of them fall over. You got debt problems, countries getting into currency issues.
Sure.
We're seeing that in Turkey, we're seeing that in Argentina. So it's the cycle playing out.
And also to the private debt markets as well. Something that Australians have fallen in love with is private debt, right?
Interesting that, a couple of years ago, private credit and private equity was only for the rich and wealthy. But in the last 12 to 18 months, they've come after retail investors quite hard. Call me skeptic. Whenever something like that happens, I always sit there and go, something's wrong here.
Same thing as
when
taxi drivers tell you they want to open a childcare centre.
Exactly, right? If everyone knows, well, there's no upside to it, right?
Correct.
So the smart money has already played that game. My guess, there's a lot of players trying to get out. They need to find the next let of investors.
That's okay. So in that case, where are the weak spots and areas the investors should be more cautious about?
Look, the obvious things are cyclicals, right?
Sure.
So in a bull market like what we've had,
Yeah.
we've had 2 to 3 years of multiple expansion.
Since 2022.
Exactly. And you can put it as tech, AI bubble. So it's just multiple expansion in growth stocks. So basic numbers is when you have multiple expansion, you're paying for future growth even further out. So if you're looking at tech at 20, 25-year high multiple, you've paid a decade of growth, right? That never works. It has never worked, right? It may be different this time, but it has never worked. So statistically, sure, it can go higher, but in reality, it just doesn't last, right? Something will always go wrong. Now, that's one side of the argument. The other side is when you have asset bubbles, what happens? Whenever people get money, they're just paying for a bigger house, or they're buying a bigger asset, or they're putting in equities, or whatever. But they're not going and starting small businesses. They're not it's like I've talked to my friends, and they run small businesses. They go, well, I worked, 3 a.m. to 8 p.m. Rather than that, I could take the money, buy a house, and sit on my butt.
And that is fundamentally, from a personal perspective, that is fundamentally going to be a very big problem for Australia's productivity, because it's ultimately productivity that drives our quality of living. When we have non-productive growth, I guess, we love property, and as an Asian, I love it too, but we need small businesses to actually innovate. We need people actually risking their livelihoods and starting these opportunities in this own country. It's
risk return, right? If you're not getting the return, why would you take the risk? If you tell someone the government will support you to push up property prices, you sit on your butt and get paid more, why would you take the risk? And so we need that dynamics to change. We need people to start businesses. We need people to start small businesses, hire young people, because our economy is a pyramid scheme. We need young people to have more kids, and the kids to earn even more than us and pay higher taxes, because someone has to pay for the aged care, someone has to pay for the super, right? The whole thing relies on more people paying more taxes. But the problem in the Western world is everyone is having less and less kids, and less people are doing businesses and growing businesses. So it's kind of the asset bubble that's supposed to help us is now hurting us, but we don't want to accept the reality.
Understood. But I'm going to challenge you.
Sure.
Australia is one of the greatest nations in the world in terms of immigration policies, right? So, doesn't that balance out then the actual birth deficit that's happening in the country?
Yeah.
And how long can that go on for?
Exactly. It's a fine balance, right? The whole idea of immigration and international students hitting the property market, that's a furphy. And it just gets blown out of proportion. When you think about the overall numbers, it's a very small percentage. And every person you get on TV will tell you, there's a lack of housing. We can solve it. How do you solve it? They go, supply. They've been talking about supply for decades. It'll never solve it, because the dynamics of how the property market is in Australia, the supply is by definition squeezed. It never delivers. We always talk about it, but what we do is we increase demand. We help demand to jam up prices, right? Because if the prices go up, the stamp duty goes up, the fees go up, the taxes go up, everyone makes more money, the industry looks good, people build more houses because they got FOMO, they think they're going to miss out, and you give someone 5% deposit, they go and buy things that they can't afford. And it's just the usual thing, right? The answer to an asset bubble and unaffordability is lower prices, not handout that gets higher prices.
Yes.
If anyone can solve debt with more debt, why would we stop? It just does not make sense. But you know what? We're going to do the wrong thing before we do the right thing.
And when do you, I guess I don't want to, again, do a crystal ball projection, but when do you think this will, we're already starting to see the 3 red lines, as you suggested. When do you think there is a time frame for all of this to start to, the acceleration of the deraveling?
Yeah, so I look at, unfortunately we have to look at politics, right?
Sure.
Because we cannot ignore it, because central banks are the dominant player.
Yes.
So we are stuck with looking at politics. So if you look at politics, US is the dominant market. So you've got to look at what's happening in US. US has a midterm election later next year.
Dominant or just loudest at the moment?
Well, it is still 50-60% of the economy. You can't ignore them. Actually, funnily enough, in Australia, we only trade like 10% with US.
Yes.
Like China basically writes our checkbook. But we care more about US because of the global sentiment.
Absolutely, yep.
So US won midterms in later next year.
Okay.
Means that US politically,
Sure.
all the politicians, their main thing is to keep their jobs.
Yes.
So the economy is now rolling over. There is political discourse. There is social unrest. There has to be a cycle for them to be running up into the midterm, right? How do you get there? The only logical way I can see in the current cycle is to bring the economy down, right, in the next 3 to 4 months, and then get it to recover in the probably Q2, Q3. So you're running into the midterm, economy looks all right, everyone's getting a bit more optimistic, your election outlook looks a lot better.
Okay.
Self-interest is a beautiful thing.
Thank you, Mathan, for explaining that so eloquently. Now, I want to move away into something more optimistic now. Let's talk about gold. Yeah? I know you've been a gold bull since the beginning of time. Look, gold's seen a record ETF inflows and it's really hitting new highs, except for 2 days ago. What do you really think is driving that strength, apart from the people lining up at Martin Place to buy the gold bars?
It is. It's scary. It's happening in a lot of countries. That wasn't quite what I had in mind. I guess we've been positive since 2019.
Yes.
Market was expensive. I know people look at the pandemic in 2020 crash and think it was a pandemic. Actually, it wasn't. The market was expensive before that. The Fed was cutting rates in 2019 because the US economy was in trouble. So the bubble was there at that time. We just made it worse after the pandemic. Now, so the gold was a defensive hedge against currency and the economy and the market risk.
Yes.
And it just kept on playing out. So we had a bit of a pullback in 22 with everything else, with the rates going up. But in reality, gold is a play on where you are in your debt cycle.
Sure.
And your currency devaluation. Now, if you look at what's happening around the world, well, everyone's in debt problem, right? Everyone is basically drowning in debt. The answer is for them, everyone uses the same thing. You either can inflate your way out, which is kind of off the table now because inflation is already high and rising, and that's a problem. They can't use it as a solution.
The playbook's been used.
Exactly. And then you've got the other problem of grow your way out. Well, growth is going lower, so that's really not playing out as well.
Yeah.
We can claim things, but in reality, it's not going to play out. So they're in this trap. So you've got slowing growth, rising inflation, and you've got debt growing faster than ever. So what is the final outcome? Well, the most likely outcome is it's probably the dumb solution, but politically, it's the easier solution. You're going to get your central banks to buy your own debt. It's the Japanese Ponzi scheme, right?
Okay.
It was fine for Japan to do it because they were a small portion of the global economy. They were net savers. They saved a lot of money.
Yep.
And they were a really big manufacturing giant for a long time. It is not something that a big economy like US can do. They're 50-60% of the global economy. They don't really save a lot. And they're not a great manufacturing country because they rely on everyone else. So for them, if they go down that path to control cost of borrowing through yield control, which is buying your own bonds, the market will lose interest. Market will worry about the US dollar and the bond yields, which is, for me, the trade for gold. When that happens, gold goes berserk. Now, the moves in gold in the last 6 months is extraordinary, right? I've been bullish. People think I'm gold bug, but that's just because it's a cycle for gold. We look for cycles. It doesn't matter what it is. And we try and invest for that cycle. The cycle for gold is huge. But what's happening now is confirming our, worry is that we're making the worst choice. We are choosing to ignore the economic problems. And we are choosing to go down the path where US most likely will have to move into a yield control where they're buying their own bonds, which is massively positive for gold.
Right. And do you think that is what is happening? Central banks are now buying up so much gold?
Well, I think the Chinese and the Russians believe that is going to happen. That's why they've been buying a lot of gold.
Yep.
So the real transition is the Asian market has moved dramatically over the last 4 quarters into gold. And that's changed the whole dynamic. So they're looking at it going, well, if US gets themselves into trouble,
Sure.
our gold is worth a lot. We can use that to pay down our debt.
Right. And so does this also mean perhaps there's a loss of confidence in the fiat currency as well?
That's the interesting part, right? And that's a fair argument. The problem is everyone's got debt. We all have debt, and all the debt is in US dollars. So you literally need the US dollars to pay for it. So there is a balance there. US will always have a play in the short to for the next decade. But I agree with you in the context that over multi-decades, I think the confidence in the US dollar is going to continue to go lower as US gets themselves into bigger and bigger problems.
Right. Now, look, I think we've already touched on it, like with inflation and currency risk rising, how important is gold as a hedge for our investors in the actual portfolio? And when we talk about gold, are we talking about gold bars, gold stocks, explorer stocks?
Look, there's a case for each of them,
Yep.
depending on where you are in the risk curve. If you're looking at lower risk investment, then you can look at physical gold. You can look at an ETF for the physical gold, and that gives you that low operational risk play. Then you can go to the larger miners, where there's Evolution, Northern Star, these big players, massive producers. They're swimming in cash. Most of them cost, all-in sustainable cost is like 2,200. They're currently making over 6,000. So they got like 300% profit margin.
Sure.
So they're doing really well. So those guys will continue to do well, but you always have an operational risk. But where the spot price is now, you have to look at the next cycle, right? So the smaller players are getting involved. And soon you'll get the explorers. So you got your Vault, you've got your Panteras, you've got your Regis, all of them are running, right? Producers, smaller players, they're running hard. Then you should look at explorers. You got Saturn, and we've had producers like Black Cat and Panteras moved across to becoming producers. Then you have to look at the next level, because history tells us gold producers, when they've got this kind of cash flow and balance sheet, they do M&A because they want to grow, they want to get bigger, so they will start to buy up other people who've already tested the asset and got proven asset, and you'll get M&A. And in the current cycle, I think where the gold price, and I think it probably is getting higher, so if it's going higher, we should start to see M&A over the next 12 months. So the smaller players and the explorers will get more and more interest.
So are you suggesting the investors who have an appetite to rotate out of the larger gold mining stocks and perhaps into the smaller ones, even potentially the junior explorers?
Yeah, I think you kind of use the standard 80-20 rule, right? If you've been in big caps, you've done well, right?
Yes.
And they are now, the big players are like Evolution and stuff. Northern Star, I think it's over 20 billion in market cap. So you've done really well, it's gone multiples. Take 20% off.
Sure.
And pick a few small producers or explorers, and you get that, I suppose, the higher beta on the cycle, because the cycle around these kind of commodity price should start to go towards, well, I've got a lot of cash. I can afford to take on debt. So I'm going to do some acquisition to assets that's near to me and grow my production. So I think that this is a time when you should be rotating. If you've done well, you should be rotating 20%. If you're doing well for a period of time, you might do more.
Right. And I guess at the moment, with those perhaps who are sitting on the sidelines, I mean, what sort of recommendations can you give them because they're thinking perhaps maybe it's a little bit too late?
Yeah, so it's always, and that's the problem with the cycle.
Yeah.
And I say this a lot on TV, is that it's really hard to buy something after it's gone 2-3 times.
Yes.
Right. But one of our stocks, one of our favorites is Codan. It's a telecommunication, but it does metal detectors and gold detectors. So it's doing really well. So in 2 to 3 years, it has gone 11 times.
Yes.
From $4 to now $35.
Is this an Australian stock?
It's an Australian stock.
That's
Codan.
a tremendous story for an Australian stock.
Yeah, it's they are a phenomenally unique business model, Codan, and they've done phenomenally well. Now, we've been in that through the cycle, and what we tell our clients is, it's done phenomenally well. You should not be getting out, but you should continue to take a bit off and then buy other things for the similar exposure.
Sure.
Because when you have a particular stock, right, you always have operational risk.
Sure.
even the best ones will eventually have some kind of risk, right? So just take some off, add to other, diversify your portfolio. Portfolio diversification is one of the key things that you need to learn when you're sitting in a bubble, because after the bubble bursts, it's too late. I'll give you a classic example. APA,
Sure.
right? Pipeline, move gas around. We got gas in the west, we don't have in the east. Boring stock. It is now up 50% off the lows, right? Nobody talks about it. It's boring. It pays you 7% yield,
Yep.
and it's gone from $6 something to now $9 something, right? And that's the whole idea. Gradually move into defensives, so your best performing exposures continue to outperform.
Sure.
But if something goes wrong, your defensives protect you.
Thank you. Now, I guess, now that you've touched on oil, I really want to talk about energy, right? It's quite unloved at the moment, you said to me off camera. Oil prices haven't run as hard as gold despite geopolitical risks. Why do you think that is?
Yeah, energy has been artificially held down, especially oil. Americans have been dumping their strategic reserve on the market to keep oil down, to keep the inflation data down.
Right.
So it's not a real measure, but that's held down the energy sector.
Got it.
So there's multiple segments to it, and they're all doing well. So you've had uranium with the data centers, AI, you need a lot of baseload energy. And uranium's had a huge run. Global uranium ETF is trading at 14-year highs. And stocks in Australia haven't actually done that well. They're playing catch up. We love Paladin. Mind you, in uranium, accept the fact that there is operational risk. They will get a few things wrong. But we think Paladin is a pretty good play. It's a producer, and it has North American exposure as well.
Yes.
So it's actually plays quite well. So uranium's doing well. People forget that you can build a nuclear reactor, but that'll take time. The existing power source is still coal.
Yes.
Thermal coal comes into play. So coal sector is getting a bit of love, but it's not outperforming yet. New Hope, thermal coal player in Australia, one of the least complex operations, makes massive cash, pays you a good yield, and the reality is no one's going to start a new thermal coal plant. They're not going to build a new mine because it's not clean energy. So existing guys will have a long time to play.
Sure.
So that plays it. And then we got oil, and then you got gas. And they're doing really well as well. Now we've got sanctions on Russia, and oil prices.
I was going to ask you what your thoughts on that.
Yeah, it's an interesting one because I figured eventually they have to come down there because Russia was never going to suddenly give up on Ukraine. So they had to come to some sanctions. And it is interesting that US is putting sanctions on Russian oil companies while buying Russian uranium and Russian fertilizer.
Right.
It's not what you say, it's what you do. So they're putting pressure on China and India to buy less Russian oil. It will be interesting to see how this plays out. Now, if that does play out and oil is reacting quite a bit, I think oil was way cheap. It was underperforming, and the market didn't want to pay for the energy sector because of that. And I think that dynamics is changing. Oil price, the other thing that you have to remember is a big part of the US production is shale. And shale producers are leveraged. So they need a higher oil price.
Sure.
So to a certain extent, everyone likes a high oil price, apart from inflation, because of that. So we're probably going to see oil price going north of 70, unless, of course, the sanctions are fake. But we'll find that out. But I think overall, we're going into a northern hemisphere winter anyway. The demand for energy is going to increase. So gas prices are bouncing, oil is following. So I suspect we're going to get a better...
Germany's always scared, Russia's going to turn off the taps.
Exactly. And they want to have a diversified supply chain, right? And so we've seen gas prices pop really hard in the last couple of weeks. And now oil is running. So all energy stocks are starting to look quite interesting.
And I think also another thing that we discussed earlier is that people overlook the fact that with all of these AI data centers, AI chip makers have had their run, is that these centers still need to be powered by an energy source.
You need a lot of energy, and you need stable, baseload, large-scale energy. So, if you're thinking gas is going to play there, I mean, I can see it, but it'll be quite expensive. So uranium makes sense, but that's going to take a bit of time. The logical answer for the next number of years is going to be probably thermal coal. to fill that gap because they already have the infrastructure. So that is going to play out, and I guess the EV move has kind of stalled. And so in that context, oil will continue to play. And people also forget that oil is just not about driving transport. Oil is pretty used in a lot of other manufacturing.
Yes.
So that will still play out. So there is a market for oil that the market doesn't actually understand. And the other problem is, if oil price is going to be this low, you're not going to get new reserves coming onto the market, which means existing reserves are just declining, and the supply-demand dynamics then becomes tighter, and then you get higher prices anyway.
I mean, for those investors right now who may not be holding any oils or energy stocks, is there any of the right now that you could give us guidance on that you think has been overlooked, presents good value?
Yeah, look, I mean, in the oil space, the only real play in Australia is Karoon.
Yes.
Brazilian assets, we've got Mexican area assets. They've expanded quite a bit, and we would expect with the oil price bouncing, Karoon will do quite well. And that's relatively cheap here. Woodside reported recently, you got good LNG prices bouncing, and Woodside had a solid result. And I suspect Woodside it's a good yield defensive play as well. So for the LNG space, Woodside looks pretty good. As I said before, in the uranium space, I like Paladin. Boss was a fan favorite for a while in the market, but it's had a few issues. So we're probably waiting for a bit more clarity there. So Paladin probably benefits from it. And Paladin has a substantial amount of shorts. So, as they perform, the shorts will get covered and you'll get a kicker out of that as well. Okay. And then if you're looking at thermal coal, New Hope is probably the biggest and the least complex.
Thank you for that. Now, I want to turn our heads back to our homeland, Australia. I mean, locally, unemployment's risen and rate cuts are inflating assets more than driving growth. I would want to know, how does that actually fit into the macro right now? And especially now that Michelle Bullock has made it clear that we may not expect too many more rate cuts in the near future.
Yeah, it's kind of a contradiction, isn't it? Michelle keeps saying, don't expect so much, but the market is saying, oh, we're getting a lot of cuts, right? And the property market is all-time high, and I'm like, so
There's a lot of euphoria leading into spring.
I know, but even before that, I mean, we're talking about, we're going to cut rates, or there's hope that there's going to be a lot of cuts, when asset prices are at all-time high.
Yes. And
unemployment historically is very low.
Yeah.
It just doesn't make sense. But to a certain extent, you have to take a step back and look at why. In Australia, we have two growth engines.
Yes.
We run property or we run commodities, right? Commodity is China. So if you looked at the last 30 plus years, we're a lucky country because China bailed us out. Every time we made a mistake, China bailed us out, right? The difference is that's all driven by construction. All right. China was either building within China or they were building the Belt and Road project all through the world. The problem is Chinese property market is in decline and no one's buying, so that's not really driving it. Every other country where Belt and Road projects may have been growing, they all have debt problems.
Right.
So no one's really driving a lot of construction. So in that scenario, commodities are likely to struggle.
I mean, but can I challenge you on this? I mean, we're looking at India here. Their GDP is growing at 8%. Vietnam's GDP is also growing at 8%. Their government wants to grow it to 10% in 2026. Can we not justify that we can turn our commodity lenses through to these other two growing nations?
You can. If everyone was logical, it would be great.
Okay.
But things are not logical. And I mean, you look at US, and I spent plenty of time there. Their roads and bridges, they just literally are falling apart.
Okay.
They should be investing in infrastructure, but they don't. This is one of the strongest nations in the world, and their roads are shocking, right? They got infrastructure wrong. They have to put trillions into the infrastructure.
Okay.
And at some point they should. If they do that, it's hugely positive for commodities. But they don't.
But they're debt laden.
Exactly.
Right.
They are drowning in their own debt. So no one wants to do it. And that's the problem, because every politician has a few years. They want to survive to the next election. Who wants to go do boring stuff like, I'm going to fix that road? Nobody does that. It's like, I am going to send someone to space. I mean, as crazy as it may seem, saying I'm going to go to Mars gets you more votes than saying I'm going to fix your road.
Okay.
So here we are.
Thank you for that. Okay, in that case, how do you actually see Australia's economy stacking up against, we're caught between a rock and a hard place, right? Between the US, our, political allegiance to them, and then we've got our trading partner, China specifically, in the next 12 months. How do we sit in between, wedged between rock and a hard place?
It just throw me a curveball. Look, it's a fair point, right? We, as an economy, we are between a rock and a hard place.
Mm-hmm.
And I'll give credit to the government. They are doing the salsa from one side to the other side.
Yes.
And they are playing both sides without taking a side. I don't know how that works, but it's working for now. And I think both sides, whether it's China or US, they understand we have to kind of play the both sides.
Okay.
And so there is this kind of unwritten balance that we are playing. And I think the government's done a pretty decent job at that.
Mm-hmm.
Now, the question is, what happens to the economy in the meantime? Because if both of them are going to stand there on a Mexican standoff, going 150% tariffs, and it's like, I'm going to stop rare earth. If this is going to keep playing out, global growth will slow down. And we are a proxy for global growth.
Yes.
And so, yes, we will slow down. But as an economy, the fact that our economy is not that debt laden,
mm-hmm.
we're not in that much of a problem. But we have an asset bubble, right?
Yep.
Our economy is running on a property bubble that's at all-time high, and it's unsustainable. And so that might come down, which means we might be in a slowing economy, but we shouldn't have dramatic slowdown.
Will you think some policy changes or some tax changes that we're probably seeing with the $3 million super tax, that's an opportunity, plus also potentially in the near future, they might be looking at capital gains taxes. There could be other forms of taxes that could actually affect our property asset bubble?
I think it's inevitable that we do it.
Yes.
But will they do it is another question.
Okay. Salsa.
Yeah, it's the salsa, right? It's the policy salsa. Like for me, I've been saying for years, probably over a decade, that we should limit negative gearing one per person. Mm-hmm. Right? You get to negative gear one property. Everyone gets one property, negative gear. You want to invest in more properties? Great. Knock yourself out, right? And what that means is then it stops being a financial instrument,
yep.
and it becomes a life necessity, right? So everyone can afford it. Everyone has a benefit of a financial benefit on their first home compared to the other people, right? Which means everyone gets to buy one house.
Yep.
Which is how you want the economy to function.
It should be a human right in Australia.
It should be. We are, a relatively well, economy. Mm-hmm. We should be, right? But because we turned it into a financial instrument, right. Because we wanted to benefit. Look, on a personal level, I own investment property. I'm talking against my own book, right? I look at my kids and say, like I talk to a lot of parents, and every parent tells you the same thing. There is no chance my kids can buy a house.
Without your help.
Without the parents. So when you're in that cycle, there's something wrong.
Yeah.
When you have an economy that's based around kids paying more taxes to pay for my aged care, my health care, my super, if they can't afford to buy a house, something is broken.
And it has a huge seismic effect socially on the country. Less marriages, and less people actually wanting to start businesses, less people trying to have families, and the cycle goes on.
That is exactly what's happening, and it's not uncommon around the world. Every country is having the same problem.
Sure.
It is obvious. We all know what is wrong, and we all know what we need to do. But as usual, we will do the right thing after we've tried everything else.
And I want to come back to this, I guess. A lot of our members, a lot of our viewers, they have accrued a lot of wealth in their lives. For them, what are you summarizing in the next 18 months in terms of how well is Australia poised to weather the economic downturn, and what defensive strategies could they employ to protect their assets?
Yeah, I think that's important, right? At the end of the day, we're investors.
Yes.
We are looking to build our capital and defend our capital, right? You cannot fight an eventual market pullback.
Okay,
right?
So that's bound to happen.
Bound to happen.
Okay.
If it's not happening in the next 12 months, it will happen in the 18 months or 24 months, right? It's going to happen.
Got it.
So you have to balance out your risk mitigation.
Okay.
So you got to have defense strategies, and you have to look at okay, if it's going to happen, you shouldn't think of it as a negative thing. You look at it as a positive thing. If it's going to happen, then I'm going to be prepared. I'm going to have a diversification strategy.
Yes.
I'm going to manage my risk. When that happens, I'm going to turn around and swing hard and take advantage of the other side.
Sure.
Right? As one thing I have learned, as old as I am, going through every crash, and since the Asian .com, you name it, right? GFC, pandemic, all of these things. You learn, and I worked around the world, and you see when I watched the GFC hit US, it was abysmal, right? It destroyed the country, and you can see how different parts of the economy how affected. There are cities that never recovered.
That is true.
I used to work for Citigroup, right? When I straight out of uni, I got picked up by Citigroup. When I left Citi in 2007, Citigroup was the biggest financial institution in the world. Right now, it doesn't even get discussed as one of the big stocks. Right? And that's the amazing part about how things can change. So my advice to investors is, you've done well, right? Whether by luck or by skill. Now it's about defending your capital, manage your risk, and position yourself. So if there is a market correction, if there is regional bank crisis, banks get into trouble, if that happens, how are you going to be affected? How are you positioned so that you are not shocked? And when that eventual recovery happens in a year or maybe even in 6 months, if that happens, then how are you prepared to move from that to the next? You have to have a plan. You have to have a strategy. You have to have a portfolio structure that allows you to do that.
Sure.
So that's, don't ever be shocked, because if you know that's going to happen, it's only your fault if you don't prepare. So prepare, manage.
I mean, I want to get into real specifics before we dive into the final topic, because your time is precious. Everyone talks about having dry powder available to take advantage of the recovery and you swing hard, right? But Ray Dalio has said cash is trash. But on the other hand, for our investors or just in general, what would be the ideal ratio of cash that you should be holding at hand if anything is to happen?
Now that's a loaded question. It depends. It depends on your risk appetite and where you are in your life cycle. If you're a young person, I think you don't care. If you're young,
but what's young?
Yeah. So if you say for example, I think if you're below 30, you should not care.
Okay.
You're going to experience at least 2 or 3 market real crashes.
What if you're 43? I'm just asking for a friend.
Don't worry. If you're in your 40s, you should have kind of like a barbell approach. So in most of our portfolio models, we have aggressive stance for about 60%. And defensive stance on the 40%. The way I look at the 40% is, what if I'm wrong?
Yes.
What if I'm wrong? What's going to protect? So things like Telstra, things like APA, things like CSL, right? They're boring stuff, right? But they've all done really well. We've doubled, tripled in most of those defensive stocks, right? And so the market completely ignores the defensive stocks when everything is running. Now that the risk is in front of their eyes, now they're buying up all these defensive stocks. That's why you have that diversification.
Got it.
Now, some of them are not cheap anymore, but they're still good defensive stocks. You can buy, rural funds. They're basically a REIT of agricultural land. APA, pipeline. They're paying you 6%, 7% yield, right? They're not going to get blown away. They have assets, right? So those kind of boring defensives should be part of your portfolio.
Yes.
So you have aggressive, you have defensive. So that's if I'm wrong, that protects you. So I think that's the kind of approach you have to do. So the more risk averse you are, you increase up your defensives.
Got it.
So, I would say if you're in your 40s, you should be looking at it probably around 60-40 at the moment. And if you're
60 aggressive and 40 defensive.
I'd still be, but it's very select. So when we go aggressive, we are very specific on the sectors that we're going with. So there is a certain level of macro opportunities there. The other, as you get older, people like me, when you get to the 5 in front of you, you kind of have to jam that out. So I'd probably say you're probably going 50-50. So I think you shouldn't when you're investing in the market, Don't look at other people and say, oh, that guy's done this well.
Correct.
Oh, I need to chase. That's not how you invest.
Yep.
It's about the long game, right? It's about long game so you don't lose your marbles. You hold on to everything. If it goes pear-shaped, you're ready. Your defensives then become offensive and you go out and have a go. And then you build your way back up, right? So it's about risk management and it's also about keeping yourself in control, right? So you've got to have a plan. If you don't have a plan, you're going to be shocked. Don't be shocked.
Got it. And now finally, I want to talk about positioning, right? So if you, again, we talked about it briefly. Let's talk about the next 12 months moving into 2026. Simple playbook for the investors that are our members at the moment. What would it be?
Look, we're long. We actually haven't changed our strategy at all.
And what would that be?
So we are long pretty much inflation sectors.
Okay.
So we're, on average, our model portfolio is about 30-40% gold.
Okay.
Which,
wow.
yeah,
okay.
And most of them have tripled.
Yep.
So
it's
that's
very high conviction.
Yes, it was very high conviction. And we have exposure into energy and food.
Okay.
All right. They're all inflation sectors. So our view is supply chain problems. These are critical stuff, policy mistakes, and they will drive it. And energy has been an underperformer. Food has held up pretty well. Gold has obviously taken off. So that's outperformed as a portfolio.
Okay.
On the other side, we have defensives, like I said, Telstra, APA, rural funds, CSL, Sonic Healthcare. So we have a few healthcare stocks, a few telco stocks, a few defensive yield stocks. We have that portfolio. And we've basically sat on that most of the last year and a half and just watched everyone go in and out of things. We haven't really done a lot and it hasn't changed at all. For the next 12 months, I still think inflation goes up. I still think there's policy mistakes going to happen. Volatility will rise. And at some point, something will break because you can't keep asset bubbles going forever. Something will break. And when that happens, I will convert my defensives into offensives, and I will go from about a 60-40 split to probably 80-20 split. So that's what our overall plan is. So, we monitor on a daily basis, weekly basis, and we adjust. But currently, that's probably what I would say the next 12-month game plan is.
Thank you. And what would you avoid? What sectors would you avoid at the moment?
I am avoiding everything to do with consumer spending or asset bubbles. So retailers, consumer services, media stocks, because they're all pure consumer spending play. So the natural thing, slow down, consumer spending down, all of those sectors get hammered. I don't care how good you are.
Sure.
Right? When the tide goes down, everyone gets hit. Right? So I'm staying out of that. Then the asset bubbles, then you look at diversified financials, asset managers. They get paid a percentage of their funds under management. Yep. If the market falls, they get paid less. Basic maths, right? So I'm staying out of asset managers. I'm staying out of banks because they're just leverage players to the asset bubble. I'm staying out of property REITs because at the end of the day, they have asset revaluation. And so those kind of things, the two main thematic, consumer spending and asset prices. Sectors linked to that, I'm staying out of.
Okay, thank you so much, Mathan. I mean, I'm so impressed with always your ability to explain extremely complex ideas into very simple ways for us to actually digest it. I hope to see you again very soon.
No, it's great to be here.
Thank you.